Good morning, everyone from London. Good afternoon to Asia. It's my pleasure to moderate this discussion on the role of social bonds in funding the COVID-19 response. We have an excellent lineup of speakers today with us. So we have Peter Munro from the European Investment Bank, Head of Investors Relations for Sustainable Finance. We have Yuri Kuroki, Financial Officer at the IFC Treasury in Singapore. And we have Christian Kopp, Head of Fixed Income Portfolio Management at Union Investment. Welcome to you all. So social bonds are becoming a mainstream instrument now. A lot of investors in ONPEP's community from public investment institutions, but also private investors are looking to integrate ESG investment into their portfolios, into their investment processes. It is a trend that was started well before this pandemic, but is now becoming more aware of the risks that social issues are causing to portfolios, but also of the impact that investors can have on social issues. It is an instrument that has grown, and we have perspectives from issuers and from investors on this panel today. As we look to exit the pandemic, the measures that governments have taken so far have focused on firefighting and providing immediate relief to support economies and provide a lifeline. But as we move into the second stage of having more targeted policies now, a lot of emphasis is placed on not just exiting this crisis, but also preventing the next crises that are coming, and ESG criteria are becoming very important there. And within the broad umbrella of sustainability, we had a lot of emphasis before this pandemic on the E part of ESG, environmental climate issues, which are still very important in the minds of many investors. But other aspects, social and governance, are also becoming more important and on the radar of investors now. So we're seeing really a big interest into the social aspect as well. So if I kick off with you, Peter, from an issuer's perspective, and the EIB was also the first issuer of a green bond back in 2007, of a sustainability awareness bond. And you're now also in Europe, we're seeing a lot of innovation in terms of the infrastructure behind sustainability. We have the sustainable taxonomy, we've had the ESM and social bonds. How do you see that in terms of from an issuer's perspective, the interest that you're seeing from investors on the S side, and how can we replicate or accelerate the progress that we've seen on the E part in the S side as well? Thank you.
Okay, thank you, Danai, and thank you for this opportunity. I think it's wonderful that you're bringing us together to discuss social aspects, given that this market has really flourished, and it is perhaps useful to look at this, let's say, from three angles. First one is just to consider for a moment the data. The COVID situation, at least in our opinion, has certainly been a game changer for social issuance, and it's really accelerated. The second point I'd like to discuss is the frameworks that are available to do such issuance and how issuers have adopted frameworks, in particular social bond principles. And the third point, which you rightly highlighted, is where do we go in terms of classification and taxonomy, and what do we have at our disposal? And certainly the EU already has some guide rails available. If we think about, first of all, the data, it's quite overwhelming. The issuance volume of social bonds has multiplied 5 times in the first half of this year relative to the same period last year. That's quite remarkable. If we look at the wider green and sustainable market, which has increased around 30% this year, you see the differential. But that being said, it was starting from quite a low base. So the volume of social issuance was somewhat over 40 billion in the first half of the year. We should not forget that sustainable issuance can also incorporate this social component, and that has also grown quite briskly. But our view is that this growth suggests that investors are starting to show interest, and we have Herr Kopf here from Union Invest, who will give us a more profound insight on this. But our impression is, at least from our observations of the market, that social exposure is now being taken at scale by investors, and nonetheless it is a relatively new area, and we feel that there is room for the influential public and private investors to show leadership here. And in terms of the approach that's been adopted, the frameworks, there are really two approaches. It seems that the pure social bond format has been slightly more popular, perhaps, and the sustainability format, which is the one that we adopted with a bit more flexibility, including green and social, is also an option. And another interesting point is which use of proceeds has been popular. Certainly amongst the European institutions, the healthcare aspect has been very much in focus, and that includes us. And coming back to the principles behind these frameworks, it's clear to us that the social bond principles have provided the globally agreed framework. And this is in a way a great success story for the principles, which, by the way, were updated this summer, including guidance on impact reporting. Now, as our friends at Moody's put it, COVID-19 intensified the market's focus on social issues, not only public health, but also other issues. That's quite interesting. Questions like inequality. Now, the social bond principles are very helpful in that regard because they already offer definitions which encompass that kind of activity. So, including access to essential healthcare services, employment generation, programs to alleviate unemployment, socioeconomic inequalities, and so forth. And of course, they also embrace the SDGs. And this shows us that the social bond principles, which were created really a while back, are now really coming into full effect. Now, are there things that we need to look at in terms of definitions? Certainly there is room to do more. I think anyone in this space would recognize that social definitions are quite challenging. The EU Technical Expert Group argued that taxonomy that has been passed, the idea of taxonomy, which has been passed into law in Europe, could provide a guide to a sustainable recovery. And by the way, the TEG reminded us, and I quote, that scientists have warned us that loss of biodiversity and disease outbreak are closely related. So if we bear that in mind, we should see that green and social are not operating in isolation. So it's useful to have a broader taxonomy. And in the EU taxonomy, there are what we call minimum safeguards. And these are based on the OECD guidelines on multinationals and the UN guiding principles on business and human rights. And those are both very rich frameworks offering us a lot of information about how to view social aspects. Nonetheless, and this is my final point, there have been calls on the successor of the TEG, the EU platform, which gets going in the autumn, to do more on social definitions. Now, I'd be interested to hear what the other panelists have to say and what the views of the audience are on this, because certainly it remains a challenging area with very many, let's say, special geographic and even also sectoral distinctions. So that, if I may, I'll close there and pass back to you, Denai.
Thank you, Peter, and thank you for highlighting also the social bond principles and the updates that we've seen this summer, and also this very important insight that we're seeing now through this pandemic, how everything is interlinked. We're seeing this very much also from the regulator side in our community at OMFEF, working with the supervisors and the central banks from their perspective, not so much in the scaling up of capital markets and working with issuers and investors, but more on the what are the regulations we need to see in the financial sector in the sense of climate stress tests, etc., microprudential policies, the recognition that it's not just climate change, there's other sources of non-financial risks that are very important, and how they link up together, like biodiversity, like zoonotic diseases, like public health, that we cannot think of these things in isolation. So thank you for raising this and describing the work that the EU is doing on this, which is setting an example for others as well. I'd like to turn to Yuri now, Yuri Kuroki from the IFC that I introduced earlier. So the IFC is also a very active issuer in this area, and the social bonds the social bond program that you have would be great to hear from you on that, and also the COVID response bond that you've issued. So would you like to tell us a little bit more about the IFC's work in this area, but also more broadly the work of international organizations, development banks, international financial institutions? We have people in the audience also from the African Development Bank, for example, who may be able to say more on this in the Q&A section, the COVID bonds that they've issued. But how do you see more broadly the role of international organizations and financial institutions in scaling up the social bond market?
Yuri, you're still on mute, I think.
You hear me now?
Yes.
Yes, thanks. So thanks very much. So quickly on IFC, we are a member of the World Bank Group and the largest development finance institution focused on the private sector. As a group, we have the twin goals aligned with the Sustainable Development Goals, which are to end extreme poverty by 2030 and to reduce inequality. At IFC, we strive for this mission by providing equity, loans, advisory services to clients in the private sector and emerging markets. In terms of the funding activities, we typically fund around 11 to 14 billion annually through bond issuances, and this includes those issued under our green and social bond programs. For the fiscal year 2020, which just ended for us on June 30th, our overall funding volume was slightly over 11 billion, of which roughly 10%, the green bond accounted for roughly 10%, and social bond accounted for 14%. So in terms of the IFC's, those two theme programs, green and social, we started with green almost a decade ago, but I would say that the turning point was really in 2013 when we did two transactions of $1 billion benchmark green bond. It provided it proved that the market depth and investor interest in the product is there. And subsequently, we saw corporate issuers start issuing green bonds, which is a key for sustainable growth of the market. A social bond, on the other hand, is a bit newer. And previously, we had two existing programs, Banking on Women, which provides finance to women entrepreneurs in emerging markets, as well as Inclusive Business, which provide lending to companies or clients that incorporate the bottom of pyramid, the poorest of the poor population in the supply chains. In 2017, we merged those two programs into what is today our social bond program. And we issued a $500 million benchmark social bond. And it was the first of its kind available to investors in US dollars. And fast forward, in early March this year, IFC issued our largest social bond to date, which was the $1 billion benchmark transaction, and then I mentioned. So this followed the announcement of IFC's fast-track COVID-19 crisis response, which has now upsized to $8 billion. And it forms a part of larger World Bank Group's commitment of $14 billion fast-track financing package. According to World Bank estimates, with the baseline scenario of global growth contraction by 5% this year, the pandemic is estimated to push over 70 million people into extreme poverty, so below international poverty line of $1.9 per day. With the package, IFC aims to support its clients to cushion the economic blow through financing that will help them continue to operate, such as working capital and trade financing. So the supranational or the multilateral roles as IFC, so for this COVID, or for the social bond, IFC was the first issuer to bring a social bond to the market after the COVID-19 was declared a pandemic. The bond was issued under our existing social bond framework, which fully aligned with the social bond principles that Peter mentioned, where use of proceeds cover social projects affected by socioeconomic crises, such as the current pandemic. The social bond gathered exceptional investor interest of over 3.4 billion, despite the extremely volatile market. This is a testament to the fact that investors are keenly interested in supporting the alleviation of the total issue of the social issues. And since then, over $50 billion equivalent of COVID-19 theme bonds have been issued by SSAs, the sovereign supranational agency sectors. And overall sustainability and social bond issuance within the SSA sector in the first half of 2020 surpassed already the total issuance in 2019. So with no additional risk beside that of the issuer, social bonds issued by supranational like IFC offer investors access to AAA investment opportunities to support social issues, including those emerging from COVID-19. And besides being a leading issuer, I would say IFC has a unique profile, also being investor as well as provider of advisory services, technical assistance, and risk mitigation instruments to create and develop the sustainable bond market. If I may take an example from the green bond sphere, IFC has partnered with Amundi to launch the world's largest green bond fund, focused on emerging markets specifically. And the goal was twofold. On one hand, to encourage green bond issuance and develop the market, and on the other, to boost green finance projects supported by those bonds. As a wider industry engagement, IFC is chairing the executive committee for the Green and Social Bond Principles this year, and we have played a very active role since inception in drafting the principles. We also co-chair the Social Bond Working Group, which has published key documents related to social bonds, including a framework for impact reporting. So I think the last part is really about the role that the multilateral like us or EIB can play in terms of the wider engagement with the investor and with the market to further grow the sustainable market.
Thank you very much, Yuri. And we also had the pleasure of hosting Jingdong Hua from the World Bank a few weeks ago on a virtual platform as well. And he shared the initiatives that the World Bank Treasury is doing on this as well, under the umbrella of which the IFC is. And thank you for highlighting also the multiple roles that multilateral international financial institutions can play, not just as an issuer, but also as partners with the private sector. You mentioned the Amundi example. There's also work that's being done there on inequality specifically, but also the technical assistance side, which is also very important. So thank you for raising that. Let's now move to Christian to get more the investor's perspective. And how do you see the pandemic really affecting the importance of ESG factors in the investment community? How do you see the differences with which they approach the social side of ESG, the social issues, compared to what work has been done already on the E part, which was perhaps more advanced before we came into this pandemic? How do you interact with both the issuers and the regulators in terms of this integration? Do you see this more from a risk perspective or from the investment opportunities that may come from investing in such instruments?
Yeah, thank you very much. So it looked like 2020 was going to be the big year for ESG before the COVID-19 crisis hit. And it now seems that the COVID crisis will not actually stop that process, but accelerate it. And I really think that this is a turning point that we're witnessing in the market in 2020, in the sense that ESG is becoming mainstream and is becoming much more important for our asset allocation and for our product offering. I think ESG so far has mainly been a topic for institutional investors. And the big turning point in 2020 is an EU regulation here, which will force investment advisors to inquire about the sustainability preference of their retail clients from 2021 onwards. So, retail clients will not only be asked about the risk tolerance, but also about their sustainability preference. And that, I think, will lead to a big
We seem to have lost Christian there. Are you back? Hello, Christian? You seem to be on mute.
It seems like I have been disconnected. Can you hear me now?
Yes, that's perfect.
Yeah. So let me just turn off. I had a bit of a technical problem here. but I hope that with a bit more volume, that should work. Yeah. So let me just start again. So what I was trying to say is that I think that 2020 was set to be the big year for ESG, and it now seems like the COVID-19 crisis is not slowing down that process, but rather accelerating it. And I think the big change that we're facing in the asset management industry is a transition of the importance of ESG from institutional clients to retail clients. Before 2020, ESG has been mainly a topic for institutional clients, and now with the new EU regulation, retail clients will be asked about their sustainability preference in the same way they'll be inquired about their risk tolerance. We've done some tests amongst our retail clients, and it turns out that up to 50% of those clients will ask for sustainability-focused products. So that could lead to a huge shift in assets from regular investment opportunities into ESG-themed investment opportunities. And there are two types of ESG-themed investment opportunities. The first one is a sort of fund that takes ESG aspects into consideration. And the second are the so-called impact funds. And those impact funds will strive to invest in companies that seek to steer their activities towards an attainment of the sustainable development goals that have been defined by the United Nations. And we think that there could be a lot of money flowing into those funds from 2021 onwards. So right now, this is still on the fixed income side a relatively marginal business for us. We've got around 2 billion in assets in green and social bonds. And I think this could really grow quite rapidly from next year onwards, once we see those inflows from retail clients into sustainability-themed funds. So in terms of the instruments that we've been looking at, before 2020, we were mainly looking at social bonds issued by commercial banks in the context of financing for social inclusion. There have been a number of social bonds directed to lending to women and to disadvantaged groups in society, and we've participated in a number of those issues. There is a very interesting case study put out by the ICMA-AMIC Social Bonds Working Group, and I would just like to highlight one of those bonds, which comes from my home country. It's a social bond issued by LBBW, Landesbank Baden-Württemberg, which is directed to the funding of affordable housing for sort of lower middle income people in Germany, and that is a bond that has a linkage to 4 of the sustainability goals defined by the United Nations. Goal number 6, clean water, and then quality of education, good health, and also shelter, goal number 11. So I think this is a general trend that we're sort of moving away from a pure social bond perspective that tries to implement the social bond framework that has been developed by ICMA towards social bonds as one of the elements in a wider SDG sort of setting. And I think from our product offerings, we will also go in that direction. We have a green bond fund today, and we are not going to launch a social bond fund, but we will likely be launching SDG funds that will encompass our social bond products and also our green bond products. So social bonds will be one aspect in a wider SDG fund offering, both for the retail clients and for the institutional clients. Now, that is the setting that we've had before the COVID-19 crisis hit. And as Peter has already mentioned, the two goals, the social bond and the green bond, are closely related and will likely be merged into joint products by most asset managers. After the COVID crisis hit, we see a huge surge of social bond issuance by mainly by sovereign entities and by development banks. Peter has already mentioned that we've had close to 40 billion. It was actually, according to a Texas study, 43 billion social bonds that have been issued in the first half of 2020. So it's a huge amount of money that is hitting the market. And we see very good demand from all sorts of funds that we manage here. We have 200 fixed income funds. And I would say the bulk of the social bonds that we've purchased in the primary market have not gone into our dedicated SDG funds or dedicated sustainability funds, but they have been purchased by the general fixed income funds that we manage, and they've diversified into social bonds, which I find very, very useful. Going forward, apart from this issuance by development banks and by sovereigns, I think there may be a role for social bonds in the funding of emerging market sovereigns, because we can see from the epidemiological numbers that the disease is now spreading very much to the southern hemisphere, and is really affecting the lives and livelihoods of people in those countries to a dramatic extent. And I think there will be a need to address these social issues that arise in those countries. Now, you may be aware that the G20 has called for a debt service suspension for a lot of emerging market sovereigns. And there are already suspensions of bilateral loans to those countries, suspension of interest payments on bilateral loans to a number of those countries. But frankly, it will be insufficient to suspend interest payments if you want to deal with the fallout from the pandemic in a lot of those emerging market countries. They will need new money. And I think that new money should come in the form of social bonds, where there's a control over the use of proceeds, where we can have mechanisms that ensure that the money that is directed to those emerging markets does not end up in cannon boats, as we've seen in Mozambique, but is really used for the social needs that have arisen as a consequence of the COVID-19 crisis. So I think that there is a large case for social bonds in emerging markets, and I think there could even be a swap of existing sovereign bonds into social sovereign bonds in emerging markets.
Thank you, Christian. A few important points there. First, that as you said, it's no longer an issue for just the institutional investors, but also for retail investors as well. And I think that's a theme for us to discuss in the discussion as well. Second, what you said about COVID-19 and not really being a setback for the ESG agenda, but accelerating that. I think that's something we should debate as well, because I know there's different views on that, but it's good to have your optimistic take that it will only reinforce what we were seeing before. And third, also the importance of emerging markets and how we can support funding through the issuance of social bonds. So thank you very much for raising these points. And to all of you for your introductory remarks. Let's now have some questions just between us, and then for the audience, if you start to think about some questions you want to ask the panelists, please let me know in the chat, and I'll hand the floor over to you to ask them when we move to that part. But perhaps to start with that point about how the pandemic is affecting the ESG agenda, because we've seen policymakers having to shift their attention immediately more to the as I said in the beginning, to firefighting, to providing immediate relief. At the same time, there are calls to let's not waste this crisis. If we're doing a lot of stimulus programs, if we're raising a lot of funding to support the economy, to start the recovery, this should be aligned with sustainability objectives. Some regulators are saying, well, we need to now provide all support we can. For example, the Bank of England postponed its climate stress test to not put more onus on the banking sector. It's a question of timing, it's a question of priorities, but at the same time, we're seeing more of an acceleration also in this awareness of having to ensure a sustainable recovery. So how do you see the impact of the pandemic on the ESG agenda? Do you, Peter and Yuri, maybe do you agree with Christian? Do you think that we'll see perhaps a falling down the priorities in the agenda, at least in the short term, but then it will become more important? And then within ESG, how do you see the social issues becoming more important? Peter mentioned the health aspects that you've looked at. Yuri, you mentioned the gender. That was something that you had focused on in some of your activities. Christian, you mentioned shelter and others. So within social, what are the topics that you think are becoming more important to investors? And Christian, you also said something very interesting, that it's just all very interlinked, and I think that echoes what Peter and Yuri were saying as well, that we can't see these issues in isolation, but then at the same time some investors have different values from others, and they're looking for more specific issues to support. So how do you see these issues, the impact of the pandemic and also the realignment within ESG and within S? So Peter, perhaps we can start with you.
Sure, thank you. I would say that Christian raised a valid point. It's important that we do not dilute the market with inappropriate assets. And I think that is very much the spirit of the ICMA social bond principles. There needs to be reporting, impact reporting, accountability. And this was what made green bonds popular in the first place, is that there was accountability and transparency. And so if Christian is right and social issuance really takes off also in emerging markets, we should ideally accompany that with all the usual due diligence. And I think that offers a tremendous opportunity for emerging market issuers to show how strong they are and what they can deliver. But it is also, in some cases, for some organizations, a bit of an administrative challenge in the first instance. And I have to applaud IFC for their work on market development on the green side, and let's hope that they and we can do more on that also on the social side, because certainly my experience in working with issuers and to some extent also with investors is that let's say onboarding this new capital markets thinking and technology is a time-consuming exercise, and we need to cut through some of the noise and focus on what's really important to deliver a viable product.
Thank you, Peter, for responding also to the points Christian raised. I don't know, Christian, if you have any responses to that, and then we can go to Yuri, to both my initial questions and to what Peter was saying just now.
Yeah, I mean, if I could maybe take up one of the points that Peter has raised on emerging markets. So a lot of those countries are really facing a massive crisis here. You know, they have a loss of revenues, and they're, you know, really struggling to cope with the fallout from the pandemic. And I think what we're seeing here is a risk that a lot of the progress that has been made over the last 20 years really erodes as a consequence of the pandemic. And that would be a real shame. The progress of integrating in the economy, the progress of in the global economy, the progress of combating poverty, absolute poverty, and you know, there are numbers out there on the number of people who face hunger in the world rising, which are quite frightening. So I think something needs to be done about that. Now, there are several ways of basically, from a financial perspective, addressing the problem. The first approach considers saying we need debt relief. Yeah, let's just get all those countries off the hook, and you know, do debt suspension, debt service suspension, and basically stop demanding them to pay for their debt. Now, personally, I'm a big fan of haircuts, as you can imagine, as a fixed income investor, and defaults and so forth. There are always cases where that makes sense. But frankly, I think it will be insufficient in this situation. We need to find a way to channel money to those countries in order to allow them to deal with the fallout from the pandemic. And I think that you know, that will require new money, and it will likely also require a change in the payment structure of the existing bonds that have been issued by a lot of those countries. I think countries such as Tunisia, you know, Pakistan, you name them, will struggle to service the debt they have contracted so far. Yeah. So, you know, I think we are at a crossroads here. We can drive all those countries into default and basically stop the financial intermediation between North and South that has developed over the last 20 years. Or we can try to drive them into a new direction. And I think their social bonds could play an enormous role. And I actually think that it will need a lot of facilitation from the IFC in that respect, and from other international organizations, both on the monitoring and on kickstarting the market. Yeah. And I think this is a tremendous opportunity for us as, you know, members of the financial market to deal with that fallout.
Thank you, Christian. Yuri, what do you see the role of the IFC in this? Do you agree with the points made by Christian, and also on the broader points about the impact of the pandemic and the realignment of significance of ESG factors?
Sure, thanks. Well, I do there's no doubt that with the current pandemic and its effect on public health in the global macro and political sphere, the awareness of the social bond is on the rise. But I would not see this as really a shift in priority. I believe the pandemic will intensify the focus of the companies, investors, and other stakeholders on the scrutiny extending beyond public health crisis to other issues such as climate change and social inequality, which, for example, can be revealed through access to health system as we go through the COVID crisis. At IFC, we place equal importance, I must state, on ESG, the environmental, social, and the governance. We see all these three as the bedrock for sustainability. So IFC has in place a sustainability framework which articulates our strategic commitment to sustainable development and is an integral part of our approach to risk management. Now, with regard to our funding, we apply a similar strategy with our use of proceeds, thematic bonds. So IFC's green and social bonds only finance projects that meet IFC's E&S standards. And we firmly support the notion that progress toward one aspect of sustainability should not be attained at the detriment of another. Having said that, so in terms of from the interaction with the investors, for example, on social bond, although we have merged the two programs, the Banking on Women and Inclusive Business, into social bond, we do continue to see, hear sometimes from the investors that they do have particular area that they want to focus. And this can change with the what's going on in globally, but also with what business they're in. For example, with the lifers, they're more focused on the human nature, etc. The reason for us to merge the two programs into one was the challenge of the issuance of niche or narrow use of proceeds theme bond is the availability of eligible pipeline to allow for sustainable issuance program. So by merging the two projects into a more mainstream program with a broad use of proceeds, we are trying to really support the growth of the sustainable, the growth of the social bond market.
Thank you, Yuri. I'd like to move to talk a little bit more about the regulation side. So Peter mentioned in the beginning the social bond principles. And you also mentioned the importance of having data to be able to determine and understand the use of proceeds. How do you see that discussion developing? Should we have more of a principle-based regulation for social bonds, or should it be more rules-based when we think about different contexts, different countries, but also the need for harmonization, avoiding fragmentation? Should it be left up to between companies and investors, or issuers and investors, to figure this out between them in terms of understanding what the needs are on both sides, or should there be more guiding principles from the regulators? What do you think about that, Peter? Where is the kind of happy medium in that trade-off?
Well, you're pointing to the key question, which is how to develop the balance between the two. I think that the important point that has been picked up in the earlier discussions is how we translate good practices globally and how we also enable good practices to develop globally. For those who are not aware, one of the recent initiatives of the EU, which has now been taken up internationally, the so-called international platform, is in a way a clearinghouse for accelerating sustainable supervision and regulation internationally, insofar as there's a lot of talk in that forum about how to align taxonomy. Now, that should be very helpful for the official sector to ensure that capital flows across borders, because what we do not want is, let's say, totally conflicting schematics. Now, to answer your question, Danai, I think that the balance has to be there between principles and rules. On the one hand, we see especially the private sector working together with the public sector to develop schematics such as TCFD And then we also see SASB. Now, SASB has gained traction on the accounting side, and by the way, EIB actually reports according to SASB meanwhile, which is interesting, as this is really an American initiative initially. And if we come back to TCFD, this was the brainchild of the FSB. So we see the connection between public and private being important. Why? Because it means that what comes out of that process will be more market relevant and more usable. And if we look at how this translates into action, the ECB, for example, has said that among its supervisory priorities for 2020, climate change is something they're looking at, especially as a key risk that affects banks. And so we will see this coming through in stress testing and also monitoring of financial institutions, how they adequately integrate risks into their such risks into their risk management. And so we can see a kind of convergence between, let's say, the broader principles and then the emergence of specific rules. And I would emphasize also the work of the NGFS in this area to give us really more of a toolkit. And if we take that down to the granular level of data, we still, and I think Christian's views will be very valuable there. We do face some data challenges. We've been sponsoring some research on this, and we do see that objectively there are gaps in the data, and this is more acute in emerging markets. But what Christian mentioned is interesting there about the forthcoming disclosure obligations. Let's remember that starting in 2022 in Europe, larger corporates will have to report the proportion of activities aligned with taxonomy, and that taxonomy, by the way, includes some of these social features. And so starting next year, companies will have to get their act together and produce this data, whether they like it or not. And that will provide a major boost, in my view, to the data gap, to resolving the data gap. And that should mean that any official sector initiatives become much more realistic. I think, as you've hinted, right thing is balance between, let's say, enabling the market to move forward, and then some sort of guide rails which prevent any bad outcomes to the extent possible.
Thank you, and thank you for opening up this discussion about data. I think we could have a whole new roundtable just about that, because it's such a big topic, but also to let you and the audience know that ONFIF is preparing a report specifically on data for the SDGs, which we will publish in September. We've been speaking to a lot of the central banks, academics, and investors on how they see this issue of data, what technologies we can use so that we cannot rely just on disclosures, because there's also the issue of overburdening smaller companies, perhaps, and how do we apply these mandatory disclosures that you say so that everyone can be on board and it's not an exclusive agenda for those who can afford it. We are also at ONFIF launching the Sustainable Policy Institute, which will be launched in September, which will facilitate discussions between issuers and investors in scaling up capital markets, but also engage the data providers, the ratings agencies, and how do we create a data landscape that facilitates this agenda, and also the regulators and the supervised institutions and the related regulations. But Christian, over to you. How do you see this issue of data and mandatory disclosures versus engaging everyone? What should be the level of prescription that we get from the regulators on this, and how do we make sure that it's inclusive, in that it includes also SMEs, but also emerging markets, that we have the same standards for everyone, but also ensure that everyone can start getting on board, and that it's not something that is prohibitive for those who don't yet have those resources, or are perhaps further behind in their journey towards sustainable investment.
Yes. So how do we determine whether a given investment that is proposed to us satisfies our criteria for a social bond or for a green bond? At Union Investment, we apply two standards. I mean, we do not only look or ask whether the use of proceeds from the social bonds are directed to the stated purpose, but we also look at the overall business activities of the issuer. So, we want to avoid a situation where we purchase bonds from an issuer, green bonds or social bonds, that finance a small portion of that issuer's business activities, which may satisfy the criteria, while the rest of the business portfolio is actually not sustainable. Yeah. So, to give you, an extreme example, we don't want to fund the kindergarten of a cluster ammunition manufacturer with a social bond. Yeah. The kindergarten may be a nice thing to do, and it's also appropriate to issue social bond for it, and then you get all the uses proceeds are going in the right direction, but it's still a cluster ammunition manufacturer. Yeah, so we're not going to do that. We look at both the use of proceeds and the fact, and we check whether the social bond criteria are met, and we look at whether the business activities of the issuer as a whole satisfy our criteria. Yeah. Now, with respect to the data gaps, I think that's a serious issue. In a way, what we're experiencing here is we have got this huge amount of issuance of social bonds, and that is leading to a lot of scrutiny. And you've got the new regulatory reporting requirements in the European Union. So we believe that those data issues will, over time, be addressed. But that for us is sort of the main topic that we have. We're in the process of writing letters to hundreds of issuers where we have our own data demands that we've defined, which are industry specific, and we will ask them to report, not only according to the guidelines of the Task Force for Climate-related financial disclosure, but according to a number of other criteria that we've developed. Yeah. So I think this is actually work in progress. We're hiring people for that. And we're really turning our entire investment process upside down. This 2020 for us is a big year in ESG integration. We're really changing, we're turning every stone around and changing the entire way we look at companies, both on the equity and on the fixed income side. Now, if you allow me, I would like to pick up one point here that Peter made on the need for capital to flow across borders, and on the fact that good data and good disclosure standards and good monitoring can facilitate that flow of capital across borders. If you look at the social bonds that have been issued so far in the market from the Community of Madrid, from Danone, from LBBW, and so forth, and you plot them against the regular bonds that those issuers have in the market, you can barely see a difference. Let's face it, in advanced economies, we're in a situation of massive financial repression with very low interest rates, and it is barely discernible, the yield of those social bonds. And I would say that most issuers in advanced economies can access the markets. They don't have a problem in accessing the market. They can get cheap funding for whatever they want to do, be it cluster ammunition or something sensible. You can use social bonds to sort of, direct those flows a bit more in the right direction. But really, it's not going to be a game changer for the issuer. The EIB or the IFC could issue as much as they want with a social bond framework or not. Yeah, and the yields it could face would be almost identical. Yeah. Now, in emerging markets, that is not the case. We've got a lot of issuers here which are facing a situation where they're cut off from the market because of the COVID-19 crisis. And I think that is only going to get worse. And I think that here, social bonds could really be a game changer. Yeah. By providing investors with confidence that the proceeds are really used for sensible purposes with proper monitoring according to the standards developed by ICMA and the European Union. And I really think that this is an area where social bonds could make a huge difference. And just one more thought on that. You may have read today in the Financial Times, Mohamed Ariel wrote about this debt service suspension initiative and the fact that we may see a lot of defaults in emerging markets. Lots of talk about that. I personally think that there is scope for a swap of existing emerging market sovereign bonds into social bonds. Yeah, and with a swap that would at the same time alleviate the payment obligations of those emerging market issuers to allow them to better deal with the fallout from the pandemic. That swap would not be NPV neutral for investors because they would give up coupons. So you would have to give them something in return. And I think there are two things that could be offered in that swap in return. The first one is social bond monitoring. If you take as an argument of Tunisia's stock of debt, you swap all that stuff into social bonds, you give them payment relief, you allow them to use the debt service relief for social purposes. And the second thing that probably would be required in order to make that a viable proposal and to make it a voluntary swap would be some form of credit enhancement. Yeah, something in the form of a partial guarantee of the principal, as we've seen in the case of the Ghana 2030 bond and a number of other bonds that have partial World Bank guarantees. So if we go down that road, I think it could really jumpstart the social bond market. If the EIB, the IFC, or other issues could, provide a partial guarantee for bonds that are swapped together with SDG monitoring, that could really jumpstart that market.
Thank you. Yeah, I think we could have a whole other roundtable on just how to deal with emerging market debt, and I think some innovative ideas coming there from you. But conscious of time, and we have also questions coming from the audience. Just a follow-up question to you, though, on what you said earlier about these letters that you're preparing and the framework that you're setting for asking directly from company additional criteria. Is that because you think the framework that's already out there is not sufficient? Because that's another big issue that we've been discussing with the regulator side at OMFIP, that if regulators don't move quickly to establish those standards, and we heard from Peter about SASB, TCFD, what the NGFS is doing, GRI, etc. If they don't move fast enough to establish harmonized or more mandatory frameworks, and we have a big gap there in terms of a big capital markets jurisdiction that is, let's say, not as advanced in the ESG agenda as Europe or Asia is, then it may be that investors move first themselves and do things like what you described in terms of their own initiatives, which is great in terms of providing more stringency, but it may also lead to a more fragmented landscape if everyone starts to do their own thing. So I'd be interested to hear what was the motivation for what you've described.
Yes. So the motivation for us is that we want to guide companies and also public issuers towards a transformation of their business activities. And we have a lot of clients, institutional and retail clients, that want to invest in those into financial products that allow for that transformation. So we need to get an understanding on the progress that those companies and governments are making over time in the transition to more sustainable business activities. I think that there are a lot of issues out there that still are facing problems, both on their environmental activities and also on the social aspects of their business activities, which are often related to the sector they're in and also the country they're in. Yeah. And we think that it's probably not appropriate to apply the same standards for every single issue across every single industry or every single country. You can, for example, see that the ESG criteria are closely related to per capita income on a cross-country comparison. Yeah. So what we want to look at is the momentum, the change in meeting social standards and in meeting environmental standards. We think that these companies and issues can be like butterflies that ultimately make it out and develop, and we want to monitor those changes. So the motivation between asking those letters and getting all those data is that we're moving away from a static evaluation of the social and environmental standards that those issues meet towards a momentum analysis. We want to look at the rate of change in meeting those criteria.
Thank you, Christian. Yeah, I think that's a very important point, because I think what is often lost between, say, the activists and governments and the policymakers is how do you also get on board those who are transitioning towards a more sustainable model
Yes.
of growth, of operation, that you can't just completely divest from those types of companies, industry sectors. You need to also bring them along the way. And how do we do that? How do we have the standards to monitor that momentum, as you said? And I like that butterfly imagery there. I think we'll keep that from this panel. But turning turning to Yuri as well.
Sorry.
This issue of
Sorry, just wanted to, well, you were turning question to me, but I just wanted to comment
I'll
on that.
ask you and then you can respond to that as well
Yeah.
I'll ask you, which is about this aspect of social washing or greenwashing. And we heard from Christian this example of the arms company, for example, building the kindergarten. How do you bring everyone on board and include also SMEs, include also emerging markets, at the same time as avoiding keeping the high standards that you have for everyone else, but avoiding that kind of greenwashing or social washing risk that you may have in trying to be more inclusive? So it'd be good to get your thoughts on that, and also on what Peter and Christian have mentioned before. And then we'll move to the audience. So the audience, if you have questions, please let me know in the chat, and after this we'll start handing the floor to you for the next 20 minutes or so.
Sure. Thanks. Actually, I think what has been discussed are also connected to the topic on social washing. But I guess to bring the credible bond program to market is imperative that issuers give investors the confidence that their investment will go to the right cause. And in this regard, the social bond principle, like those principle in the market, is the market's most reference framework for structuring or issuing and reporting on social bonds, and that's what we're trying to encourage. I mean, we follow that, and we try to encourage with our clients to follow that as well. But having said that, the clients that we do business, our business partner, are in the emerging market, and as has been discussed, they may not necessarily be at the standard yet, and it is very much IFC's work there is to do not only the investment, but work through the advisory, the technical assistant work, and do the to bring up the clients up to the standard of the ESG, the risk management of the ESG risk through the performance standard of IFC, which has become the global standard now in terms of the risk management there. For bond issuance specifically, we did have a project in Asia. I think it was in Philippines, where we invested into a client issuing green bond, and them they were not necessarily following the international, the ICMA's green bond principle, but they were adopting the local, the regional, the global green bond standard, and we do recognize that. But I think what we additionally do is through the technical assistance advisory part to in the practice try to follow the international, closely to the international standard of the monitoring and the reporting, and that's how we try to still work but help the clients be up to the standard of the international or the global best practice.
Thank you very much, Yuri. We'll now move to the audience. There's been some questions coming through. So first from Cedric Grimaud from the Climate Bonds Initiative. Cedric, do you want to take the floor and ask your question about sustainability-linked bonds?
Yes, hi everyone. I wanted to ask whether the emergence of the sustainability-linked bond principles, which has been released by ICMA very recently, will be a game changer for the social bonds, because they potentially align the return on the bonds with the changes that the issuer will be able to deliver through the issuance. And also, I think it has an impact on the broader strategy of the issuer as well, in aligning it with the sustainability long term. So I would be interested to hear from the panel what they think about these new principles.
Thank you very much, Cedric. Peter, would you like to start on this? You mentioned also the ICMA principles at the start of your remarks.
Yeah, I mean, I've been working with the Green Bond Principles Excom on the kind of fine-tuning of this product, actually. I have to say other colleagues have been leading the working group on that, and they've done a great job. I think what is clear is that there was a huge interest in the market after the success of sustainability-linked loans. Okay, so KPIs linked to overall issuer achievements, to ensure, in a way, also that the firm as a whole was going in the right direction, which is Christian's point earlier. Now, whether or not we need financial penalties for people who misbehave is another matter, and that's kind of the philosophy of this product, is there would be some penalties. So let's see how the market takes this up. I mean, you could also imagine other structures where you have sustainability linkers where there is not necessarily a financial penalty, but for example, the index provider then is the one which does a bit of policing, which we did see for certain green bonds which didn't conform and were then kicked out of the index. So, you know, there are different ways of doing this, but I think the notion that the issuer as a whole should have integrity is an important one, and the sustainability linked bond principles are very much behind that. And if I may, I would just say that we can also think about this in connection with the point of transition, which was made earlier. Transition is embedded already in the taxonomy of the EU. That's the first point. And the other point that was interesting earlier was the question of how we do the technical assistance to help issuers who are not quite there yet. And in fact, I was working while I was on loan to ICMA on the IFC technical assistance, and I think it was potentially a very powerful vehicle to transform the ability of issuers to get up the learning curve. And I'll be doing similar work here at EIB, also within the EU and potentially in emerging markets, because we believe that there needs to be an effective partnership between those who have done this work, done the homework, and created, let's say, the roadmap and the templates to make this scalable, and those who have yet to enter the market.
Thanks, Peter. Any views from you, Yuri, on that? So set on the principles for the sustainability linked bonds.
Yeah, I think it is an interesting development, and there's the principle out there. So I think there's a potential of the growth, especially when now we do talk about the lack of supply for the use of proceeds bond size. So for like the social bond and the other labeled bond. I would actually just be interested to hear from some investor side whether in terms of having this structure of as Peter said, penalizing investors, those, because it is not the straight bond, how the investor absorb and whether the issuance in a large size would be possible I personally haven't had enough interaction with the investors, so would be keen to hear that voice from the investor.
Thank you. Christian, over to you then.
Yeah, I've got sort of mixed feelings on these KPI bonds or sustainability bonds. If I understand it correctly, the idea is that if the company misbehaves, the coupon goes up, right? So that sort of leads to perverse incentives. I mean, if I have a bad year, as an investor, I might call up the company and tell them to misbehave in order to get some more income. Yeah. So I'm not sure that this is really aligning the interests in the right way. I think that there is something else that could be done here, and that is designing good governance. And we've got a situation where when we call up automakers or auto part makers, and we ask them for the scope 3 emissions. You know, scope 3 emissions are the CO2 emissions along the entire supply chain that then translate into the products. They're telling us we're not going to tell you. Yeah, and sometimes difficult for us to do something about that. So I think that going forward would be nice to have a little initiative, maybe of public-private initiative, to design a very good and stringent disclosure covenant for corporate bond issues. That if companies fail to disclose certain numbers, then their debt becomes immediately due and payable. Yeah, I think that could install some sense of urgency in the issuers.
Thank you, Christian, in a very innovative mood today, suggesting various ideas there. I think We'll post this discussion also on our website. I think it's being recorded, so we can share that with relevant people in the policy side there. But we have another question, and for the audience, please keep sending them through, and I'll hand over to you to ask them. So from Jyoti Bisbee from the United Nations Economic and Social Commission for Asia Pacific. Jyoti, would you like to ask your question about emerging markets and regular issuance versus social bonds and regulation?
Yes, sure. Thank you, everyone. So I have actually a couple of questions kind of combined into, so the first question is, do you see much difference in yields and rates of social bonds for emerging markets versus regular issuance, which has been coming even before COVID? And the second question is on regulation, and I think some of the discussion already kind of mentioned some of this, but I want to really understand the emerging markets. You know, many of these countries don't even have fully established green bond principles or even regulation in place. And I think by extension, what most of the countries in the emerging market and developing economies are trying to do is extend what they actually have thought about green bonds into social bonds if they are thinking about issuing something during this time. So how do you reconcile this? Because there's going to be, I mean, the transition which we are talking about, the needs are today, and by the time they actually kind of get a handle on this and they actually package it, which can be monitored and reported and disclosed, it's going to take a long time. And then in the same kind of question I have, you know, we are talking about COVID and social bonds, and the needs today are more for containment. And if we are going to develop something which is along the lines of inclusion, businesses led by women, you know, those are something which are going to probably we can see over medium term. So how do you package the social bonds in a way which can actually address the needs immediately and at the same time encourage alleviation of social issues over the medium term? Thank you.
Thank you, Jyoti. Peter, would you like to start with that on the issue about the difference in yields and rates for social bonds versus regular bonds, and also this question around regulation and emerging markets and COVID? There's a lot there, so take your pick. We have various panelists to cover.
Yeah, I mean, I think Christian has made the point that financially these products tend to turn out quite similar. There is some academic research on green, perhaps less so on social, because the data is less rich and less deep, showing that risk-adjusted returns can be superior, at least in secondary markets, for some types of green bond, in particular from large frequent issuers who have a high degree of credibility. And you know, that's both academic research and research from certain asset managers. So if you go into the sort of primary space, is there potentially an attraction for issuers? Is there any kind of advantage? Well, you know, for a very small number of issuers, there might be a marginal one. EIB's green curve is arguably slightly inside the generic curve, so there could be some sort of advantage. But I think that when we see that large hedge funds are getting into this space, we know that there is something there financially. And so let's not ignore that. But I think the more important point that was raised was, you know, how do we, in a sense, onboard the right sort of use of proceeds? Well, there is a lot of work actually being done by the official sector to integrate SDGs into their policies, and that should produce a significant amount of expenditure which can then be associated with these kind of financial products. So I'm quite optimistic. A lot of that has been going on in the background for quite a while, and if you look at the UN 2019 Global Sustainable Development Report, you see there has been quite a lot of movement. So maybe it's a matter for investors to scan that a bit more deeply, see which jurisdictions are well advanced, and creating the right sort of flows of capex and opex to justify this kind of market.
Thank you, Peter. Christian, do you want to go next?
So first, how do those social bonds trade? Right now, they trade relatively flat to the regular bonds. For example, if you look at the African Development Bank 2024, which is a social bond that trades totally flat to the African Development Bank curve, the African Development Bank 2028 trades around 5 basis points inside the interpolated curve for that issuer. So there's not a lot of differentiation here right now in the market. And second, how do we package social bonds so they make sense for emerging markets? I mean, if you look at those countries right now that are sort of challenged from the COVID crisis in an existential manner, they have around 50 billion of sovereign bonds outstanding. And as of now, we have no idea what that money is being used for. We really don't know. And now these sovereigns are asking for debt relief and debt service suspension. So one way to package that stuff in a proper way would be to swap the existing bonds, 50 billion, I'm talking 50 billion here, to swap the existing bonds into new social bonds, yeah, that have a proper monitoring mechanism from the IFC or somebody else, and have some partial guarantee. And then you can immediately jumpstart that market and move from 3-4 billion to 50 billion to a total, to big stock of debt. That's the way I would go about it.
Thank you, Christian. Yuri, any final thoughts from you?
Yeah, I guess on the return part, I would just add that on Peter's comment that yes, some studies show better performance for the theme bond, and in the long term, and I think that's the key. The long term performance can be better, and that there's some studies on that it has performed better for the thematic or the social green bond. On the social bond supporting the immediate COVID effect and the longer term, I think the current social bond principle is defined in a way that actually can cover both. It does have the targeted population, but also recognize that addressing the general public can actually serve to help the targeted population. For IFC on the supporting side, so the short-term or the fast-track package is what we call it phase 1 of the COVID response, and it's primarily focused on really like the short-term financing on the trade financing and working capital, but we are working on the phase 2 of it, which is more and on the longer term, where we try to like the restructure of the financing and addressing the impact. And surely the impact of the pandemic would be felt and is felt by the more vulnerable people, and social bond can support those people in the project.
Thank you, Yuri, and thank you, everyone. We've come to the end of this session, but I think we've discussed a lot in terms of how the COVID-19 pandemic and the policy responses are affecting the sustainability agenda. I think there's been a consensus that we're seeing a strong emphasis on this, also facilitating regulations, the principles of ICMA, as well as a lot of work to do on the data side and on emerging markets. I think that came out quite strongly out of this discussion as well. But good luck in your upcoming activities. I think we need a lot more issuance in this area. That's the feedback that we're getting from our investment community. It's not just data that's a barrier, it's also the supply. It's still a small part of the market, these labeled instruments. So thank you very much for joining us today, and we look forward to engaging more with you on this. I mentioned UNFIF is setting up the Sustainable Policy Institute in September, so we look forward to having more discussions as part of that. Thank you very much.